Over the last few years, we've seen a shift in how we work. Remote work went from being a buzzword to a reality. We are now working remotely more and more, and the benefits are huge. For us as individuals, working remotely offers us much more flexibility, in some cases, higher pay and higher salaries, in other cases, a better work life balance with no commutes. For companies, they have access to a wider range of talent. They get to reduce their overheads and spending on offices, coffees, and things like that. And in some cases, even increased productivity. So while it has all these benefits, remote work has another layer that adds a bit of complexity to it: taxes. As a remote worker in South Africa, you need to understand what your tax obligations are and how to navigate them. We're going to talk about that in this video. Tax residency is the most important concept to consider if your employer is overseas and you travel often. In South Africa, we have a residence-based tax system. What this means is if you're a tax resident, you're taxed not just on your income in South Africa, but your global income. If you make some money in South Africa and you make some money overseas, all of that income combined is what you're taxed on. Your tax residency is going to be determined by two tests. The first test is the Ordinarily resident test. This is where they look at what your center of gravity is. Your life revolves around your true home. So this would be where your social connections are, your family is, most of your assets reside, and where you return to when you go on trips. If the ordinary resident test doesn't work, then the physical presence test kicks in. What's the physical presence test? The criteria to determine whether you're a tax resident using the physical presence test is that you need to meet three criteria. If you're in South Africa for more than 91 days in the tax year, and if you are in South Africa for more than 91 days for each of the last 5 years. So every year for the last 5 years, you were in South Africa for more than 91 days. And you were in South Africa for the last 5 years for a total of 915 days. Basically, they're trying to determine if you are in South Africa for more than 91 days over a 5-year period for each of the years, and in total, it's 915 days that you have been in South Africa, then you're going to be considered a tax resident. Why is this important? Well, if you cease to be a tax resident, then you're only going to be taxed on your South African income. If you don't make any income in South Africa and you're deemed not a tax resident, then you're not going to pay any taxes. However, if you were a tax resident and you cease to be a tax resident, you need to factor in that an exit tax may come into place. So an exit tax happens when you basically leave South Africa or cease to be a tax resident, and it becomes quite complex. So understanding where you stand and how that's going to impact your taxes is going to be very important. Once you've established your tax residency status, let's look at your tax obligations. Let's start with income tax. If you're in South Africa and you're working for a South African employer, but you're working remotely, you will still pay PAYE taxes. Your South African employer is supposed to deduct your PAYE each month, remit it to SARS. You will then do your annual submissions every year. Nothing changes from a tax perspective. If you are a remote employee of a foreign company, you will now need to register as a provisional taxpayer and pay your taxes yourself and manage that. We have a video discussing provisional tax and how it works. Basically, you will need to pay the first batch of taxes in August, the second batch in February, and you can pay a third one before your taxes are due. While there have been discussions about foreign employers submitting PAYE on your behalf, as it stands, you are responsible for your taxes. If you're an independent contractor, whether working for a foreign company or a local company, you're definitely going to be a provisional taxpayer. That means you need to compile all your information and submit it yourself. The responsibility to pay your taxes is on you, and you use the provisional tax system to actually pay your taxes. That brings us to value-added tax. So if you're an independent contractor working for a foreign or local company and you cross the 1 million rand threshold, then you will need to register for and pay VAT on your income. The source of your income is considered based on where you're providing the service. So as a tax resident, if you are providing your services while you're in South Africa and you're providing it to an overseas company, your source of income is considered to be South African. South Africa has double taxation agreements with many countries, so you will need to understand based on the country that your foreign employer is in and South Africa what the relationship is and how to work that out. As a basic rule of thumb, if there's a double taxation agreement in place with the country which your foreign employer resides in, then you may be able to just pay the additional tax in South Africa. But you'll need to make sure that you understand how that double taxation agreement actually works between South Africa and the country in question. This is one of the most common questions we get. What can I claim as an expense? So yes, you can claim expenses, but understand that there are strict rules. So a home office expense, for the space that you use as an office, there are strict rules around. You need to have that as a dedicated space and you need to use it as an office for rendering the services that you provide. So you can deduct, and remember, it's based on the square footage of the home office versus the entire home itself. Internet costs, generally speaking, independent contractors can claim and deduct internet expenses, whereas employees, you would need to have some sort of justification. If you're specifically getting an allowance for internet costs, and if your employer specifically requires you to use internet, so there's going to be some criteria around that for employees. But independent contractors, you're most likely going to be able to deduct your internet costs. Travel expenses, only business-related travel expenses will be deductible. The common rules that you understand will typically apply. So you can only deduct if you're going to a business meeting, if you're going to specific to a client or something like that. But you will need to have robust proof. So you need to keep logbooks, you need to keep records of those meetings and things like that. Okay, so quick recap. You need to know your tax residency status. Your tax residency status will determine which of your income is going to be taxed by SARS. You need to understand your source of income and how that is calculated. You need to distinguish between employee and independent contractor. And flowing from that, you need to understand what deductions you can make. You'll need to make sure that you comb through all the different tax laws and relevant guides to understand what applies to your specific situation. Otherwise, consult with a professional who can help you navigate this space. I hope you enjoyed that video. If you did, please like it and subscribe so other remote workers just like you can find this content. I'll see you guys in the next one.